Tyler, you and I both have followed Berkshire Hathaway and its legendary CEO, Warren Buffett, for a long time. You've probably read every shareholder letter he's ever written. I haven't quite read all of them, but we know there is a massive amount of pithy advice, lessons about his own experiences and mistakes. But there's one piece of wisdom he's given in there. It's not really advice, but it certainly says what most investors should be doing.
I remember it a long time ago. It was actually in the 99 meeting. He basically said, for people who want to pick individual stocks, start with the A's. Just start turning over stones. And the most important part that he said was start with the smaller companies because they're more likely to be mispriced. And he's even mentioned it a lot lately where a lot of the companies that would be interesting for Berkshire today just aren't realistic because they're too small. There's only with a Berkshire size, there's only so much they can do with when you're trying to deploy, I don't know, $200 billion worth of capital at a time.
Yeah, no, that's exactly right. It's $1 trillion company now, or somewhere around there. The market cap is finally past that massive landmark round number. But that's the key, is that he said I could do better with $1 million today than $1 billion today as an investor in terms of the gains that he could get, which means instead of ordering off the Berkshire Hathaway menu of portfolio of stocks, maybe look at the themes, the tailwinds, the unit economics that a lot of those companies benefit from, and find the smaller versions of similar businesses that should be able to do better than what Berkshire has to buy, again, because of the massive scale and size of that portfolio. I'm Jason Hall. This is Investing Unscripted. Tyler Crow here with me. We're going to give you our two stocks to buy that Buffett might actually be buying today if he was a regular investor like the rest of us. Not going to speak for him, but we think directionally they're definitely kind of Buffett-esque. Before we get to the details of those two great stock ideas, though, we've got a great opportunity for you with our sponsor, The Motley Fool. If you're looking for even more great stock ideas, go to our special link. It's fool.com/unscripted. Go to that link and you can get access to The Motley Fool's 10 best stocks to buy right now. Again, it's fool.com/unscripted. Okay, Tyler, what's your stock?
All right. So Berkshire Hathaway, it's not in the publicly traded portfolio much, but it's actually, it comes up a little bit more in kind of the wholly owned businesses. It owns like Clayton Homes and a bunch of other basically construction material companies. So it's really much, it's a residential construction is an industry that Berkshire seems to be attracted, or Buffett seems to be attracted to, or has over the years. And so because of that interest in its company that I've followed for a long time is Green Brick Partners. This is a residential home builder, much like the larger ones that you hear of, like D.R. Horton, Toll Brothers, Lennar, the companies like that, but they are considerably smaller. They're a $3.4 billion company, which is by Berkshire standards, that's very, very small. And the reason that I own this one and one that I think investors should look at more often is that in my opinion, Green Brick Partners is one of the best underwriters in this business. And I think it's an underappreciated trait for much of the home building industry. I think there's been so much talk among the investing crowd about being land light, using lot options to keep low capital obligations and keep a clean balance sheet. But, if I underwrite a bad lot option, it's no better than underwriting a good bought piece of land. And because of Greenbrick's very conservative underwriting, they keep a very low debt profile. All of the things that they do as a business just scream conservatism, and management itself even mentions like per share value is the thing that we focus on. And that obviously is kind of music to my ears when we're talking about businesses. And so it has been for years one of the best performing stocks in the home builder industry despite the ups and downs that we've seen, and largely attributed to that very conservative nature that they have taken with this business. Now, when you hear conservative, it makes it sound like, oh, well, they must not grow very fast. But for much of the 2010s, when we were in a decent build cycle, we were talking about 15 to 20% revenue growth every year. It's gotten a little wonky over these past couple of years, obviously, with the post-COVID kind of weirdness. But this is clearly a business that had its sights on growth, but doing it in a very responsible way.
Just for some context, over the past 3 years, Green Brick Partners stock is up 280%. And some of that is a little bit of multiple expansion, Revenue's up about 56%. Earnings per share is up 138% over that period. The stock went from very cheap to basically reasonably valued, I think is the way to think about it. Tyler, I agree. I also own Green Brick with a handful of other smaller home builders as well. Cyclical industry, like you said, but housing is a problem in the US. There's simply not enough. We have not built enough over the past roughly decade. And with what feels like even more weakening access to existing inventory, we have not seen this massive baby boomers selling out of their larger homes and downsizing into smaller homes that was expected. There's just not enough available inventory. And Green Brick has done a great job. Like you said, the 3 L's, land, labor, and lumber. When it comes to the land part, you have to buy it in the right place, and you have to buy it at the right time, and you have to pay the right price. They're really good at all of those parts of underwriting land at prices that make sense, and then developing it and selling it and turning it over quickly and moving on to the next one. I agree. They're just really, really good operators. So I agree with you on Green Brick. I'm going to go in a different direction here, but still thinking about some of the areas where Berkshire and Buffett have done very, very well over the long term. And that's in banking, historically in really big bank names like JP Morgan. Wells Fargo was a large holding for a long time. Bank of America has become a large holding. Ironically, it's one that they've actually started to trim that Bank of America position a little bit. I think more for reasons that have to do with freeing up capital at the corporate level to have more cash to be able to deploy than any reason that would maybe indicate to retail investors like the rest of us that we would maybe want to think about selling Bank of America. But again, I think we can do better. I think we can do better than buying one of the 2 biggest banks in the US than Bank of America, as much as I think it is a great business. And I'm going to shift this to a smaller bank that is way, way too small to be on the Buffett short list of stocks to buy. And that's Axos Financial. In a previous iteration, it was known as B of I Holding, parent company behind Bank of the Internet, which was one of, depending on how you define it, it was one of the 3 or 4 first internet-only banks that were ever founded. The thing that's happened is that is really under their current CEO, who's been the CEO really since the financial crisis. It's moved from this basically jumbo mortgage lender in Southern California during the global financial crisis, which they managed to get through fine because of, hey, another funny thing, really good underwriting, in this case, underwriting reasonable risk in finance and lending. They got through that. And it's such a more diversified business now, Tyler, with broad lending, commercial, industrial lending, more than just residential lending as well. Some different finance things that they do. They have a lot of financial services products that they offer that are beyond just traditional commercial banking. And you put it all together and it's a more diversified, lower risk business, but one that's also exceptionally profit. If you look at the chart I've got on the screen. So the peer group, I will say this, I want to quibble a little bit with the peer group here. This is mostly just regional banks, a lot of which are brick and mortar. So a lot of like the efficiency ratio and return ratios are because it's comparing itself to businesses that have higher fixed costs because they have lots of brick and mortar locations. But nonetheless, these are some great ratios. Like the efficiency ratio, this is the percentage of its revenues that have to cover its operating expenses. So lower is better. Exceptionally good here. The returns that they get are very good and consistently good because they've never had an issue with lots of big loan losses. They are consistently good at underwriting and they get really good profitability. Net interest income, 4.5%. Compared to 2.5% for the peer group. You look at like the B of A's of the world, they're still way under 3. So it's exceptionally profitable business. So it's really appealing to me from the profitability perspective. It's smaller and also the valuations are really attractive as well too. So I'm going to compare it to Bank of America. And this is, I think, really enlightening. So if we look at the book value, about 1.7 times book value, so more expensive than B of A and most of the big banks. And the big reason there is because of its asset-light model. If you look at those profitability levels, it's worth a higher book value because it is a more profitable business. But even though it's more expensive on a book value basis, you start looking at the earnings multiples, it's cheaper, trading for about 9 times trailing earnings, less than 10 times expected forward earnings. It trades for really attractive earnings multiples as well. So I think this is definitely a better growth opportunity for investors that are looking to do better than what Berkshire owns. If I were going to buy a bank right now, Axos would definitely be near the top of my list.